For 26 years, there was one number every Australian investor could rely on. Hold an asset longer than 12 months, and you'd only pay tax on half your capital gain. The 50% discount. It shaped how people bought property, how they bought shares, when they sold, whether they sold at all. And from the 1st of July, 2027, it's gone. Not under review. Not proposed. Gone. The legislation received royal assent on the 26th of June this year. It's law, and the internet has already decided what it means. Property investors are finished, or share investors are finished, depending on who's yelling. Here's the problem. Almost everyone has the story backwards, because here's what the headline misses. The end of the 50% discount is the part that changes almost nothing between property and shares. The discount applied to both. A share investor holding over a year got it. A property investor holding over a year got it. Same rule, same benefit, both sides. So when you take it away from both sides equally, you haven't tilted the contest at all. You've just raised the tax on long-term gains across the board. The thing that actually decides property versus shares under these new rules isn't the headline. It's buried underneath it. And to see it, you have to run the numbers. So we did. Same investor, $200,000 of their own money. 10 years, top marginal tax rate. And to keep it fair, we assume the shares and the property grow at exactly the same rate, 6.5% a year. That way, any difference we see comes from the tax rules, not from guessing which asset wins. The share investor puts their $200,000 into a broad basket of index funds and ETFs. Unleveraged, simple. The property investor does what property investors actually do. They use the $200,000 as a deposit, borrow $600,000, and buy an $800,000 investment property. Same money in, a much bigger asset, because of leverage. From July 2027, instead of halving your gain, the tax office does two things. First, it indexes your cost base to inflation, so the part of your gain that's really just inflation isn't taxed. That part is fairer. But second, it applies a floor. A minimum 30% tax on whatever real gain is left, even if your normal rate is lower. For most long-term investors, at today's inflation, that trade is worse than the old discount, not better. Indexation only beats the old 50% discount if inflation runs hot, north of about 4% over a decade for an asset that doubles. Below that, you pay more. And the faster your asset grew, the more it stings. Super, by the way, is untouched. Funds keep the old treatment on assets they hold directly. That's its own quiet story for another video. So what happens to our share investor? Their $200,000 grows to about $375,000, a gain of roughly $175,000. Under the old discount, the tax on that gain was about $41,000. Under the new rules, about $56,000, around $15,000 more. That's it. That's the whole change for the share investor. 15 grand over a decade. And one thing they keep completely untouched, franking credits. Those franked dividends over 10 years are worth about $24,500 in tax the share investor simply never pays. Property has no equivalent. That advantage survives the reforms entirely. Now, the property investor. And this is where it gets interesting. Their $800,000 property grows to just over $1.5 million, a gain of just over $700,000. Much bigger, because leverage bought a much bigger asset. So surely losing the discount hammers them. Here's the surprise. Their capital gains tax barely moves. Under the old discount, about $164,000. Under the new rules, about $166,000, a difference of $2,000 on a $700,000 gain. How? Two reasons. Indexation shelters a big chunk of that gain, and all those years of rental losses. The property ran at a loss every single year. Get carried forward and knocked off the gain at the end. Between them, they almost perfectly cancel out the loss discount. So if the capital gains tax barely changed, where did the property investors' pain actually come from? Negative gearing. Every year, that property bled money. Rent didn't cover the interest and the costs. Under the old rules, that annual loss came straight off the investor's salary. And at the top rate, the tax office effectively refunded 47 cents on every dollar of loss. Over 10 years, that's about $57,500 back in their pocket year after year. That's what's being taken away. From the 1st of July, 2027, for established residential property bought after budget night this year, those rental losses can no longer be written off against your salary, only parked and used later against rental income or against the gain when you sell. So add it up. The property investor's total hit isn't $15,000 like the share investors. It's closer to $60,000. Almost 4 times as much. But look at what that hit is made of. Almost none of it is the capital gains discount, the thing the headline screams about. Nearly all of it is negative gearing. The reform that's actually reshaping property investment is wearing a capital gains tax headline. Now, some honest caveats, because this is a model, not a prophecy. We assumed both assets grow at the same rate. In the real world, they won't, and reasonable people argue endlessly about which grows faster. We left stamp duty out to keep it clean. But on an $800,000 property in New South Wales, that's another $31,000 of friction shares never pay, before you even start. We assumed an interest-only loan and didn't reinvest the income. Change those dials and the dollar figures move. What doesn't move is the shape of the story. The discount change is symmetric. Negative gearing is where property actually shifts. And franking is a share advantage that survives. And there's one carve-out that changes everything for property. New builds. If the property is a brand new build, it's treated completely differently. New builds keep negative gearing. And new builds can still choose the old 50% discount. So the government hasn't killed property investing. It's split it in two. Established homes lose their tax advantages. Brand new construction keeps them, and then some. That's not an accident. That's the entire point of the policy. Push investor money out of bidding on existing homes and into building new ones. So the old playbook, property beats shares on tax, rested on 2 legs: the capital gains discount and negative gearing. The discount leg was never really property's own. It shared it with shares the whole time. And now the negative gearing leg has been cut off for established property. What's left is a far more level contest than the property lobby will ever admit. So what do you do with this? First, know which regime your asset lives in. Established property bought after budget night, a new build, shares, and anything inside super are now 4 genuinely different tax worlds. Don't run the old assumptions across all of them. Second, if the entire reason you were eyeing an established investment property was the negative gearing refund against your salary, that specific benefit is going away for new purchases. The case has to stand on the property itself now, not the tax break. Third, don't sleep on what shares quietly keep. Franking credits didn't move, and the cost of getting into and out of a share portfolio is a fraction of properties. That's not nothing. And none of this is a reason to panic sell what you already hold. If you owned it before budget night, you're very likely grandfathered under the old rules. Timing matters, and the details are genuinely fiddly, which is the perfect place for the disclaimer. And I mean this one sincerely. This is general information, not personal advice. I'm not your accountant, I'm not a financial advisor, and I don't know your situation. Tax law, this new has edge cases the professionals are still working through. Before you make a single decision off the back of a YouTube video, this one included, talk to a registered tax agent about your actual circumstances. But go in with your eyes open. The headline told you the capital gains discount is gone. And that's true. What it didn't tell you is that the discount was never the thing separating property from shares. Now that the dust is settling, the real question isn't property or shares, it's which version of each. And does the old story you were told still hold up? For a lot of people, it doesn't. If this helped you see past the headline, do me a favor. hit like and subscribe. It genuinely helps the channel reach more everyday Australians trying to make sense of all this. See you in the next one.